This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh. In today's video, we'll take a look at Fisher Paykel Healthcare, given that share price has retraced quite significantly, down 29.17% year to date. Now, you might have noticed I previously have made a video on Fisher Paykel Healthcare detailing what the company does, the products it sells, the company management team, as well as looking at the company's moat and the financial metrics. At that time, I came up with a valuation for the business of between $25 to $26. Right now, it is well below that $25 to $26 range, trading at $23.48. So I'll revisit the company and look at what sort of caused the share price to drop recently and come up with a valuation multiple considering the additional information that we've got for Fisher Paykel Healthcare. So none of this is financial advice. This is not a recommendation for you to buy, hold, or sell Fisher Paykel Healthcare stock. Just me sharing my research on the company. And before we begin, I want to plug ShareSite because tax time is coming up in New Zealand. So if you have over $50,000 invested overseas in US and international markets, then you might need to file for FIF. And we know FIF is a relatively complicated tax to calculate. So I use ShareSite personally to calculate my FIF taxes. If you're interested, check out the link down below. You get 4 months for free when you sign up with an annual plan. All right. So with that out of the way, let's get right into the video. So as you can see over here, Fisher Paykel Healthcare currently trades at $23.48, and they've retraced from about $27 to $28 over the past week on the back of a revenue guidance management issued on the 23rd of March. So over here, there's two important things that you need to know. The first one is that the company expects full year operating revenue for the 2022 financial year to be in the range of $1.675 billion to $1.7 billion. So this range of $1.675 to $1.7 billion is below the analyst consensus of $1.729 billion. Another thing to note as well is that freight rates remain elevated, and for the 2022 financial year, I expect it to impact our long-term gross margin target of 65% by approximately 250 basis points. So in other words, their gross margin this year will be about 62.5%, which is well below their long-term gross margin target of 65%. So these things really got the markets shook because now they don't expect earnings to be as high as before, as well as revenue falling short of their analyst consensus estimates. So that sort of caused the sell down of the Fisher Paykel Healthcare shares. Now it also aligns with what we're seeing overseas, with the hospitalization rates with COVID. As you know, Fisher Paykel is a huge beneficiary of the increase in hospitalization rates because of COVID, because their treatments in nasal high flow is used as an effective treatment against COVID-19 related lung problems, right? So with the decrease in hospitalization rates, that will also impact the hospital side of revenue, and that's obviously come down now, and the market is forward looking and so expects hospital revenues to also come down. Now over here, I've taken a screenshot of the analyst consensus before and after the earnings downgrade. So over here, the first screenshot is a screenshot taken from my previous video on the analyst consensus at that time. So that was as at June 2021, after they released their full year results last year. And I also taken the most recent earnings estimates. So this is as of March 2022. And you can see that the earnings per share from the June 2021 estimates to the March 2022 estimates showed a relatively big downgrade. So for 2022, EPS was expected to be 0.63, and then now it's 0.66. So it's increased by 3 cents. However, if you look at 2023 and 2024, EPS was 72 cents and 87 cents, and now that's dropped to 59 cents and 70 cents. So that's a relatively big drop off. And analysts expect earnings to bottom out in 2023 now instead of 2022 before recovering towards 70 cents per share. So I've put this on a graph over here on the EPS forecast. There's 3 different lines over here. The first green line was the previous EPS forecast, which shows that earnings basically bottom in 2022 and then recover. And the darker green line is the current EPS forecast, which shows that earnings bottom out in 2023 before recovering. And there's also a blue line over here, which is the hypothetical no COVID EPS forecast. In this hypothetical situation, what I do is I take 2019 EPS and grow that by the long-term growth rate that management targets for revenue of about 12%, and grow EPS by 12% annually. So the reason why I use 2019 is because 2019 was the latest year that wasn't impacted by COVID, because 2020 started to have an impact of COVID, and you can see that the earnings has sort of spiked up in 2020. So using 2019 numbers, this shows that if COVID didn't happen, this would sort of be their long-term growth rate I'm expecting, right? And as you can see, the earnings that is currently forecasted going into 2024 is still about 10% higher than what would be if COVID didn't happen. So I've come up with a very rough calculation on the valuation of the business, which I'll share with you right now. So looking at the past 5 years, next 12 months price to earnings ratio, the company traded most recently at 37.43 times. And as you can see that this P ratio of 37 times is roughly where the company traded at between 2018 and 2019 before the spike in the PE ratio happened because of COVID. This is a P ratio that I'm fairly confident the company will trade at, assuming that conditions normalize in the future. And we can already see that from the COVID peaks that PE ratio has started to normalize as well. So using a back of the envelope calculation, we can take the PE ratio of 37 times multiplied by the FY24 estimate of 70 cents per share, which is taken from over here. And using the rate of return of 10%, which is what I expect out of this investment, we can come up with a very rough valuation calculation for Fisher Paykel Healthcare shares. So to come up with the valuation, you would take 37 times multiplied by 70 cents per share, and that gives you a share price of $25.90 in 2024, assuming that the company trades at a 37 PE and delivers an earnings per share of 70 cents per share. Now, obviously, we're not in 2024 yet, so we have to discount that number back to what we are currently paying at in 2022. So that's 2 years of 10% return. So you would divide this by 1.1 to discount that 10% back twice. So 1 and 2. So you would basically pay $21.40 today after discounting it by 10% each year for 2 years. And this is about $2 higher than what the company is currently trading at $34.44. So a lot of things have changed from my previous valuation when I came up with a $25 to $26 range. Obviously, earnings have been downgraded going forward, and they now expect, the analysts expect that earnings will bottom out in 2023 instead of 2022. So this obviously will cause some headwinds for Fisher Paykel Healthcare shares. The share price historically for Fisher Paykel has followed their earnings. So if earnings stall, then we might also see the share price stall. So that's how I'm thinking about it. I haven't started a position in Fisher Paykel Healthcare, but I think, around that $21, $22 mark, I'll be very interested. So that's not far from where the company is currently trading at. Now, an important thing that you need to consider as well is whether that forward PE ratio of 37 times makes sense, because given that we're in a rising interest rate environment, a lot of the high PE stocks have been sold down, and so we've seen their PE ratios contract a little bit. Now, the PE ratio that you would pay for a company really does depend on its future growth. So if we look at the Fisher Paykel Healthcare's future growth profile, we can see that the company has already announced in the previous half-year results that they will, over the next 5 years, invest approximately $700 million in land and buildings. Of the $700 million that they'll spend in land and buildings, the company will build its 5th building, completing its Auckland campus and acquiring land for a second New Zealand campus. And they also expect to deliver an additional 3 manufacturing facilities located outside of New Zealand, the first of which is currently under construction in Tijuana, Mexico. So hopefully we'll see that reduce freight rates going forward into the long-term future. As well as that, they say that the long-term impact from COVID-19 for our business has been a larger installed base of our hospital hardware and increased global physician awareness and experience with our therapies and products to ensure we're well positioned to meet demand for the ongoing use of this installed base of hardware and accommodate our strong product pipeline, we are continuing to invest in our infrastructure to ensure it supports our long-term growth. So to give you some context on the current property, plant and equipment balance, as at the most recent half year, this was 917 million. So they will definitely increase it by a significant amount of 700 million. It's about 75% of the current balance. So this is huge growth. The company is continuing investing. They're not using their windfall gain from COVID to, make some crazy acquisitions. They are just reinvesting in the business and planning for the long-term growth of the company. As well as that, there's one tailwind going for the company as well, and that is that it's one of the largest, actually it is the largest holding in the NZX 50 index. So what that means is that passive investors buying into the NZX ETF or KiwiSaver funds buying into the NZX ETF, for every dollar that goes into these funds, 14 cents will go into Fisher Paykel Healthcare shares. So this is a huge tailwind for the business as the New Zealand KiwiSaver fund balance continues to grow as people start investing more into ETFs. Fisher Paykel Healthcare will have the biggest benefit out of all the other NZX listed stocks out there. So this is also one of the reasons why the company has traded at a relatively elevated PE ratio, and why this could potentially be the case, continue to be the case going into the long term. Obviously, this is a double-edged sword. If the market contracts, if people start redeeming their KiwiSaver balances, especially those baby boomers, then we might see this trend reverse. But in my opinion, I think the trend will be positive for Fisher Paykel Healthcare. So after all that is said and done, I haven't started a position in Fisher Paykel Healthcare yet. I am waiting for it to retrace closer to my valuation target, which is not far from the current share price. So with the earnings profile bottoming out in 2023, we might actually see Fisher Paykel Healthcare share price not move anywhere for the next year or so. I don't want to make any bold assumptions because usually I'm wrong about these things, so we'll see how it goes. So let me know what you think about Fisher Paykel Healthcare shares in the comment section down below. Always keen to hear your thoughts. Thank you guys for watching. Until next time, take care.